Hello, ladies and gentlemen, I hope you are doing fine wherever you are. I am the ACCA tutor, Mr. Jerry Muchemkulu. In this video, we are going to proceed with our study journey in the ACCA FA2 paper. All right, this is week 2, and the lecture is actually on recording business transactions. Like I said, my name is Jerry Muchemkulu from Transcal Business School. And those are my numbers if you want to engage me in this study journey. All right, so the ACCA FA2 paper is fully known as maintaining financial records. That's the name of the module. All right, the lecture is actually dedicated on the art of making sure no dollar goes missing. Yeah, the objective of the trainee or of the student is actually to ensure that they maintain the books of financial transactions as accurately as possible. So this paper is actually telling us or teaching us how to make sure that no kobo or no cent or no dollar is not going to be, unrecorded. All right. So what we are going to, to learn is actually some understanding of the flow of data. We need to understand how the data, actually financial data, flows. Then we will be introduced to the books of prime entry, and we would actually appreciate what these books are by the end of the lecture. Then we will be able to master the double entry bookkeeping system. And lastly, we'll be having or we'll have a recap of the accounting equation. Like I said, in the week 1 lecture, we talked about the accounting equation. So if you want full detail on that aspect, please revisit the week 1 video. Now, how does information flow? Before a transaction reaches the financial statements, please be in mind, financial statements are often called the main accounts. Financial statements are also called, what can I write? Which pen shall I use? Right. They're also referred to as main accounts. Okay. So before a transaction reaches the main account or the financial statements, it travels through a specific path. Think of it as a funnel. Yeah, these transactions follow a certain route, and they don't just jump and wake up in the financial statement. So this is why when auditors come and they find a certain figure which doesn't have supporting sources or supporting documents, and accountants end up being in trouble. So everything has to have some source record. So what the statement is referring to is that there should be a source, right? And there should be some, some trail through which the account or the figure has traveled. There should be some audit trail. All right, so there should be some source documents like invoices, receipts, credit notes. First, before we see a figure in the financial statements, we need to see the source documents. After the source documents, we need to see the prime records where that figure was recorded before it is found in the financial transaction. So we see that a figure has been taken from the invoice. It is then recorded in the books of prime entry, or sometimes called the day books, where we first capture the data. Let's say we receive an invoice from the supplier. We then have to capture it into the purchases day book, for example, right, as the book of prime entry. Then that transaction is then referred to the ledger system. The ledger system is where the double entry magic happens. And last week in our previous lecture, we talked about the double entry. Now, in this lecture again, we'll revisit the concept until it sinks down into our memory lane. Then number 4, the trial balance. So after the transaction appears in the ledger, then we can talk of the trial balance. This is a final check to ensure everything balances. Why do we have to worry about balancing? This is to ensure that information is captured immediately so it isn't lost or forgotten. All right, so if your trial balance is not balancing, it could be that something has happened or an error has been committed during the capturing and recording of the transaction. So you need to understand how these things work. Now, let's talk more about the books of prime entry. Like I said, not every transaction goes straight into the financial statements, the main accounts. We have to use specialized journals first. So let us look at the books of prime entry. All right, so those are the books, and we want to see what they contain. Okay, let's start with the sales day book. This one records all credit sales invoices issued to customers. So when we originate an invoice to a customer, a credit customer, those guys who buy on credit, all right, we record them in the sales day book. So every day we make an entry. Whenever a customer comes to our shop and buys things on credit, we then have to record the transaction in the sales day book. Right, which means when we originate an invoice to the customer, we then have to capture that invoice in the sales day book. I think that one is clear, loud and clear. Then purchases day book. This one, just like the sales day book, records all credit invoices received from suppliers. So when we receive invoices from suppliers, we then have to capture them into the purchases day book. Now, the cash book. This one records all bank movements, receipts, and payments. So if we receive cash, we need to record it in the cash book. If we make a payment, we also have to record it in the cash book. So all bank movements. When I say all bank movements, the word bank refers also to the cash which we would have used. But in most, in most companies, cash is kept at the bank. So this is why the bank movements has to be written as such. All right, and only some pet cash some small amount of cash is going to be kept in our safes at the offices, at the shops, or at our working environment. So in that case, we will use what is called the petty cash book. All right, this one records some small amount of money. So small office tea, coffee, stamps, cash expenses are then recorded in the petty cash book. Lastly, the journal. This one records unusual transactions, unusual stuff. For example, error corrections, year-end adjustments. They are recorded in the journal. Okay. Let's move on. Now let's talk about the ledger family. The ledger. This is where all the business records stay. They live in the ledger. All right. So in accounting, a ledger is simply a book or digital file of accounts. It's a book or digital file of accounts. So we have what is called the general ledger or nominal ledger. All right, this is the boss ledger. Contains everything: wages, rent, assets, sales. So many things are going to be in this record. They're going to be in this record. But we also have what are called sub ledgers. All right, the two main ledgers, which doesn't necessarily have to be part of the double entry bookkeeping system, although they follow the double entry, they are not really linked, all right? They're not really linked to the general ledger. These ones operate independent of that ledger. The reason why they have to be independent is that we needed to check. This is why we have got a dedicated topic on control accounts, where we need to see if the balances in these separate ledgers, for example, the receivables ledger, has to have a balance, a closing balance that is similar to the one that is reported in the general ledger. So when we look at the receivables balance in the general ledger, we then have to, to match it with the receivables balance in the receivables ledger. This is to cross-check ourselves. All right. Remember the receivables ledger. This one, the receivables ledger, this ledger is actually having all the credit customers. All right. So each customer has got a separate account in the receivables ledger. So we then have to say, let us say in the receivables ledger, we have got Mr. Smith. This is just an example. Mr. Smith, Miss Kane, and Miss Chido. All right, so these are our credit customers, right? So the receivables ledger has got a separate page for Mr. Smith, separate page for Miss Kane, and another page for Miss Chido. These guys would be having certain balances. All right. So if we add up these balances, all right, let's say they are $1 million. All right. We then have to find the same figure on receivables account, which should speak of 1 million. So the general ledger is actually the total, captures only the total of 1 million. But when we add up the accounts of Mr. Smith, Miss Kane, and Miss Kane, we should come to 1 million. That's the idea. So the receivables ledger records the who owes us list. Actually gives us the who owes us list. That is detailed accounts for every single credit customer. Similarly, payables ledger, the who do we owe list. It gives us the list of those guys who we owe or whom we owe. It details accounts for every single supplier. That's the payables ledger. Now, let's move on to the next item. There is a golden rule, the accounting equation. The entire system rests on one logical pillar. Assets is equal to capital plus liabilities. We have talked about this equation in the previous lecture, that is week 1. So if we want to translate what this equation says in plain English, what the business owns, the assets, is equal to what the business owes to the owner. Remember, I said the owner and the business are two separate entities. So when the owner injects money in the business, he or she would have loaned the business. It's a loan to the business. But this loan is different from ordinary loans because it is coming from the owner of the business, and that loan is given a special name called capital, the C. That's the capital we are talking about. It's a loan that was given to the business by the owners. When the owners are fed up, they simply take their money and go, and the business does nothing about that. All right, although maybe with certain rules and regulations, different setup or different types of business have got certain rules. For example, companies, you don't just walk up and just say, oh man, I just want my money which I invested on the company's shares, give me my money, I want to go. No, there are certain legal limitations to that assumption. Then there's also this L. It is also a loan, but this one is an ordinary loan. So it is given the name liability. So whatever the business owns is equal to what the business owes to the owner, the C, plus what it owes to the outsiders, the liabilities, the L. So every single transaction has two sides. Every single transaction, please be in mind, be with me these statements. It's actually something very, very important. Every single transaction has two sides. If you buy a car, the asset goes up, right? So we are having this arrow going up. If you buy a car, assets go up, all right? For cash, assets go down. So sometimes a transaction can trigger two things within the same category of uh, you know uh, elements, or within a certain element. For example, assets. Remember, you buy a car using cash. All right. At one point, cash was an asset. All right. In the bank, it was a bank asset. All right. So let's say we had $500 in the bank as cash. All right. But we buy a car for, let's say, $250. All right. So automatically the 250 is leaving the company and we are left with how much? With 250. So this means that the asset cash, because we deducted it here, this was a deduction. We deducted 250 to buy a car. So the asset cash has left the company. So it has decreased. This is why we've got a downward arrow. Okay, the asset cash has decreased, but the asset cars have increased. All right. So if you buy a car, asset is increasing. The asset that is increasing there is the car. All right. But the cash is going down. So in this case, because asset car is increasing, we are debiting car. How much? $250. And crediting cash. How much? $250. So this is why we said every single transaction has got two sides, the debit and the credit, an increase and a decrease to some extent. But sometimes it can happen that it will trigger an increase and increase. As you will be doing examples, you will see what will be happening. All right. But one thing for certain is that a transaction is going to trigger a debit and a credit. When your transaction is only going to trigger a debit only, then something will be wrong. All right. And I also want you not to memorize that whenever we are talking of a debit, everything will be increasing. No. Or when we are talking of a credit, everything will be decreasing. No, it doesn't work like that. All right. It doesn't work like that. All right. Let's proceed. Good. I have got this, table there. All right. One thing for certain, the debits, remember, there are what are called T accounts. So the debit on the T accounts is on the left side and the credit the right side of the T account. All right. Now, when assets are increasing, when assets are going up, all right, when assets are going up, we debit the asset. For example, in the case of the car which we bought for 250, we said we debit car. We are increasing the cars, so we are debiting the asset. All right. So whenever there is an increase in the assets, we are debiting. However, when the assets are decreasing, for example, the asset cash, which was decreasing, when the asset cash was decreasing here, when the asset cash was decreasing, all right, we say that we credit. All right. Where is my cursor? Right here. We credit cash. Why? Because the cash was leaving the company's coffers. So it was reducing, and hence we credited it. All right. So a decrease in assets, we are crediting. All right. We are crediting. So we are crediting the asset. Okay. So we'll credit assets when decreasing, but when increasing, we debit assets. Similarly, an expense, if the expense is increasing, right, we debit expense. But when the expense is being reduced, we are crediting expense. Liabilities, all right. Liabilities, profits, and so forth, they are by default credits. All right. So when a liability is increasing, this is the default position. When the liability is increasing, we are crediting liability. All right. But when the liability is decreasing, we are debiting the liability. So liabilities can also be debited, but you need to know to interpret. You need to know how to interpret the decrease, how to interpret what we mean by debiting liability. As simple as that, isn't it? All right. Income, like I said, by default, they are credit balances. So when income is increasing, we are crediting income. When I talk of income, I talk of sales, I talk of revenue, I talk of profit, all those things, right? So when they are increasing, we are crediting income. But when they are decreasing, we are debiting income. All right. You can use the pro tip. Remember dead click, where debit expenses, assets, drawings. All right, which means when these guys are increasing, we debit them. And then when we talk of the credit, uh, the liabilities, income, capital, when these guys are increasing, we have to credit them. So the other way to look at this is we used to, when we were at high school, we used to have the acronym. We used to have the acronym PEOS. All right, that was a very, very useful acronym back in the day. We used to use this acronym. So I feel like I can't actually, run away from it because it served my day. Okay, so the first P there, the P. What was the P then? Oh, that. Okay, P was purchases. P was purchases. E was expenses. A was assets. So A was assets. All these guys, purchases, expenses, assets, whenever they were increasing, we were debiting. Okay, and this other guy is on the right side here. The revenue. Okay, this one was revenue, and like I said, revenue, that's revenue, sales, liabilities. This one, share capital. This one, share capital, or just capital. The S. All these guys, whenever they were increasing, we were crediting. So you can see that you can use the PO's acronym, or you can go with the dead click. All right, they work hand in hand. You can use them to memorize as aid memos. Okay. So the opposite is also true when these guys are now decreasing. If they are decreasing, you just have to change the order. Like for example, for the assets, when they are decreasing, you then have to ensure that you credit. And these other guys, when they are decreasing, you just have to debit them. All right, it's as simple as that, isn't it? Great. I'm sure you need to replay this part of the video so that you won't be confused. Let's proceed. All right, let's talk about practice, because practice makes it perfect. So let's start with the first example. Then you buy $500 of stationery for cash. You buy $500 of stationery for cash. The double entry you need to do is that you need to debit stationery account, that is the expense account. Stationery is an expense, so we say that using our POs, using our pills, okay, so using our pills, we know that these first guys here are increased by debiting and these ones by crediting. And we know that pills are an expense. And where are the expenses? Expenses are these guys. Okay, these are the expenses. So whenever we incur an expense, we are increasing the expense. So we are debiting the expense, all right? So if we are debiting the expense, so the first thing you need to understand is that you need to understand the nature of the transaction. Is it an expense transaction? Is it an asset transaction? Is it a liability transaction? What is it? All right. So because if you don't know the transaction, then you are not going to know what double entry is suitable for it. All right, so in this case, we buy stationery. So we have incurred an expense. All right, so we are going to debit the expense. So it is actually good to actually mention what expense is it, because in a business you might enter into various transactions for expenses, some for rentals, some for salaries and wages, some for stationery. So it is good practice to mention the actual name of the transaction. So in this case, these are stationery. So we have bought stationery. So we are going to debit stationery expense. Okay? Debit stationery $500. So you are seeing this upward arrow suggesting that we are increasing the expense. So we are debiting it. All right. And crediting, we are crediting cash. Why are we crediting cash? Because we have bought stationery for cash. Cash has left the business. So we are seeing a downward arrow there suggesting that cash has been reduced by $500. We come to number 2 there. You sell goods for $1,200 on credit. So you have made some sales. And if we go to the PO's acronym, we say that sales are revenue. The R there stands for revenue, sales. Okay. So the sales are increasing. So if sales are increasing, we credit sales. So this is why you see an entry here. Credit sales, that is income is increasing by how much? 1,200. But this was now income increasing on credit, not by cash. There's no cash that is taken place. Why? Because we have been told that they were sales on credit. So if there were sales on credit, it means that a certain asset has resulted, not cash this time, but the receivables. Receivables are our credit customers. So we are going to debit a certain asset. This asset is called receivables. So we are debiting. Why are we debiting? Because these guys are increasing. Assets are increasing. So we are debiting. We are debiting receivables. Okay? Receivables, how much? 1,200. So the full double entry is debit receivables 1,200 and credit sales 1,200. Lastly, you pay a supplier $200 that you owed. So you have paid. If you have paid, it means that cash has gone out, all right? But you have also cleared a liability. All right. So what has happened here is that the asset cash, the cash asset is not going up, but it is going down. All right. Cash has left you. All right. So cash is going down. However, the liabilities, because remember we were owing this money. All right. So the liabilities have also gone down. All right. We have cleared a certain liability by $200. So the liabilities have gone down. And if the liabilities are going down, if these guys on this side of the pills are going down, it means that we have to debit them. So this is why we are debiting liabilities. But this type of liability is a payable. Remember, there are various types of liabilities. This type of a liability is a payable. What are payables? These are credit supplier accounts. They are credit suppliers. So this is why we are debiting a liability. Debiting a liability is reducing a liability. Why? Because by default, these guys are increased by crediting. Remember, they are increased by crediting. But when we are now reducing them, we need to debit them. Then we are then crediting cash. Why? Because initially, cash is an asset. When it is being increased, it is debited. But this time around, it is not being increased, but it is being decreased. So we are crediting it. So we are crediting the asset by the same amount. I think I've been loud and clear. Now let us attempt this quiz. What is the double entry for paying wages to employees? So we are paying wages, all right, to employees. So wages is an expense, all right, but we are also paying. So we are actually settling the expense with an asset where cash is leaving us. So if cash is leaving us, which means an asset is getting down. If an asset is getting down, it means that we are crediting cash. Then here we paid an expense, so an expense is increased, which means we are going to debit the expense, which means we are debiting the wages. Remember, we need to mention what type of expense was that. So we are debiting wages and crediting cash. So what is our answer? The answer there should be B. Another question, test your knowledge. What is the double entry for buying a computer on credit? Right? So this time around, we are buying an asset. So an asset is increasing. So if an asset is increasing, we are debiting asset. What type of asset? A computer. We are debiting computer. All right. And we are buying this on credit, which means there is a certain liability which is a payable, and when a payable is increasing, we are going to credit it. So we are crediting payable, which is a supplier. Okay, payable in bracket supplier. So what is our answer? The answer there is B. It's simple, isn't it? Now let's talk of the balancing act. We have often seen these CD or BD. CD, that is balance carried down, and BD, balance brought down. Okay. Now at the end of the month, we need to find out what is left in the account. So what do? We need to add up both sides. So remember, like I said, a T account is like this. For the So we have the debit and the credit. Okay. So let's say in case of capital, let's say the capital was $100 at the start of the year. All right. And we added something. We added cash. The owner maybe injected something, right? So we get some $50. So we need to add up these amounts at the end of the year. So it comes to 150, and we also have to add something here to 150. So we should have what is called the balance CD. The balance CD, okay, should be 150 here. But the balance for this account is actually the balance brought down. So here we need to have a balance BD of 150, all right, which becomes the opening balance of the account. All right, now so we need to add up both sides like I did here. We added up the side and that side, and then we put the larger total at the bottom of both sides. So the larger here, remember there was initially there was a zero on that other side. I mean on the debit side here there was nothing. Remember, all right. So the larger side was the credit side. So this is why we added 150, and we put this 150 in both sides, right? because the statement is saying you need to put the larger total at the bottom of both sides. So the larger total was the 150, so we put it on both sides. And then we need to add a balance CD that is carried down to the smaller side to make it match. So this is why we put the balance CD there. All right, then you bring that balance down to the opposite side of the new month as balance brought down. So this is why I've brought it down like that. So you must clap hands for me. Great. All right, let's look at this fully worked example, starting a business at its initial transaction. So the owner starts up the business in on the 1st of January 2018 by putting $10,000 of cash in as capital. So the $10,000 was the capital cash. From the business point of view, its cash has increased by 10,000 and its capital has increased by 10,000. So if we go to the cash account, this is the cash account. The cash account is going to have a debit balance of 10,000. We are debiting cash, the cash account. We are debiting the cash account with the capital. This, be careful with the narration there. All right. So the account here is the asset account, and it is going to have a debit opening balance there. All right, great. Then at the same time, we are also going to open the capital account. Like I said, the capitals on the side of the POs, the capitals are on the, they are credited. Remember our POs acronym. All right, this is the capital, the S, the share capital. Remember, this is the share capital, right? Share capital or capital. All right. So it is on the credit side. When they are increasing, if we are increasing them, we credit, right? We credit them. So we are still following the same principle. So this is why we are entering, we are making an entry on the credit side of the capital account. Notice the cross-referencing between the accounts. The entry in the cash account is described as capital, as I've already indicated, which is where the cash came from. The entry in the capital account is described as cash, the nature of the capital injected. So, on this particular day, things owned, cash is equal to things owed, capital. Remember, our accounting equation, assets is equal to capital plus liabilities. So in this case, the assets which we own as the business is 10,000 cash $10,000, which is equal to capital of how much? $10,000. Remember, there are no liabilities at the moment. Okay, we're only told that the owner has injected cash of $10,000. So the cash the business has is $10,000, which is equal to the capital at the moment. There are no liabilities so far. So the accounting equation is assets 10,000 equals to capital 10,000. Now, transaction 2. The business buys some equipment for $2,000 cash on 3 January 2013. So they bought $2,000. Cash has decreased by $2,000 and the cost of equipment has increased by $2,000. So in the cash account, we are still having on the debit side 10,000 and equipment 2,000. That is on the 1st of January 2013. All right. But if we have to close up this account, if we close up the account, it simply means that we have to say, if we do that closing, the balancing or the closing out. Remember the balancing act, okay? The aspect of CDs and BDs. We're going to have. Remember, we were told that the side with the larger amount should have its amount appearing on both sides of the T account. And then where there is a lesser balance, we just have to have a balance CD, and the balance CD here, that's the difference, which is 8,000. Okay, and this should be here on the debit side. Remember, it goes on the opposite side, the balance BD. So whenever you're doing this T account and you find yourself having the CD and the BD on the same side, you might be in deep soup. You might be having some error somewhere. So that's 8,000. So they go in separate directions. So that's a debit of $8,000, which is the net of the debit and credit side. Is that clear, ladies and gentlemen? Great. Now, the equipment account, we bought some equipment by cash of $2,000. That's the account which we have. The asset of cash decreases and that of equipment increases. And the capital hasn't changed, all right? The capital hasn't changed. It remained like that, right? Now, the accounting equation is that we are going to have cash of 8,000 and equipment of 2,000. These are the assets which are equal to the capital. The capital doesn't change. It's still the $10,000. It is being explained by the cash which we have and the equipment which we have bought. Great. Transaction 3. On 10 January 2013, the business purchases goods for resale of $5,000 on credit. So we are still utilizing the amount of money which we have. All right. So, but in this case, we did not use hard cash. We were allowed to buy the goods on credit, so our cash balance is not affected. So we still have the cash account has got the capital debit of 10,000, but remember, because we made some adjustment, the actual amount that should be our balance now should actually be the 8,000. However, we still have to continue to use the capital just to, not to confuse ourselves, right? Because by the end of the day, we can as well do the closing up and come to 8,000 here. All right, so we just have to track, we took the original transactions from day 3 as discussed in transaction 2. All right, so just for some historical chronology of the transactions. So we have got the equipment we just bought, all right, and the capital is to as that, and the inventory transaction, because we bought this on credit for 5,000, all right, and the suppliers, remember now we now have the liability, all right. This is the liability or the payable of 5,000. All right. So this time around, we now have, the accounting equation. Now has got the assets of the cash 8,000 and the equipment plus the inventory now, because we bought inventory on credit. So all these represent the asset. And then we have got the capital, the C here, and the liability. All right. The C was the capital of $10,000 plus the goods which were bought on credit. They created a payable, okay, the suppliers of $5,000. So the accounting equation has then been fully represented in this case, because we now have got the assets, the capital, and the liabilities. So A is equal to C plus L. Transaction 4 on 15 January 2018. The business sells half of the goods for 4,000 credit. So if half of the goods were sold for 4,000, remember the goods were bought for how much? 5,000. The full goods were bought for 5,000. But now we sold half of these. We sold them. So actually, of goods were sold for how much? They were sold for 4,000. So which means there was a profit of how much? there was a profit of 1,500. There was profit of 1,500. So if there was profit, there should be something that has to take place. Anyway, let's go stage by stage. So the profit which was created 1,500. All right. So we start with the chronology. Initially, this was the transaction which was recorded, and the equipment transaction. Then the T account is also appearing, the capital account. Now, of interest is the inventory, okay? Because initially the inventory was having, this entry when we bought the goods from the suppliers. The inventory had a debit of $5,000. However, the inventory has been reduced by crediting the cost of sales, the cost of goods sold. Remember, some of the items have been sold, half of them for, which were worth 2,500. This was the cost of the goods. Remember, this was the full cost of 5,000. All right, but half of that cost has left the business. So 2.5 is leaving. So this is why we are crediting the inventory account. Remember, the inventory account is an asset account. When we want to reduce it, we credit it. We make a credit, a corresponding credit account. So this is why we are having a 2,500 credit entry there. Now, the suppliers are still owed $5,000. Remember, we bought the items for $5,000 on credit. So whether we sold all or half, it doesn't matter to the suppliers. They want their money in full. So they still want their $5,000. The customers, we sold the items. Okay, we sold the items for $4,000. So these items were sold on credit. So if they were sold on credit, if the items were sold on credit, we then have to have the customers, or let me just say receivables account. So the receivables account is having $4,000 there, because that was the amount of sales we made. All right, this could be the sales. Actually, it's the sales amount there. It's the sales or revenue entry there that should be appearing, not really the profit. We did not make the profit of $4,000. Our profit is only 1,500, which is included in the sales figure. Then we also have to create the sales account, or sales or revenue account. And this one, like I said, they are credit by default, right? So we make a credit entry to show that the sales are increasing by how much? By 4,000. All right, and then the cost of sales or cost of goods sold, by their nature, cost are expenses, and when they are increasing, we are debiting them. So this is why the cost of sales account itself, we are only increasing it by the inventory cost all right, of 2,500. Remember, these were the items which were sold. So they were half of 5,000, which is 2,500. So let us formulate the accounting equation given the information which we have touched upon so far. The things owned by the business are still cash 8,000, equipment 2,000, inventory now 2,500. Why? Because the other 2,500 has been sold. Then the amount due from customers, that is the receivables of $4,000. So all these are the assets which are equal to the things owed to suppliers, the 5,000. Remember, the suppliers sold us goods on credit, so that was the liability, which is our L, plus capital 10,000. This is the C, plus profit. The profit here, that's 4,000 minus 2,500, which is 1.5. All right, so 5 plus 10 plus 1.5, this gives us 16,500. So that is the transaction. I mean the equation, the accounting equation. So it is just I mean an act of putting the accounting equation into practice. Now, transaction number 5. On 31 January 2018, the suppliers are paid what they are owed, and $100 is paid for rent. So we are now having the rent coming into the picture. So day 5, the rent is an expense and decreases the profit. Paying suppliers what is owed to them has no effect on profit, right? But the rent to some extent has got a profit impact because it reduces our profit. It is an operating expense. It reduces our profit. So as usual, we've talked about these. Remember, the cash account had capital debit as the source of the cash initially, and then we utilized that cash on buying the equipment, on paying suppliers, and on paying rent. So if we balance up, all right, if we do the balancing, we should come to here. If we put our 10,000, remember the 10,000 is the larger amount, so it has to appear on both sides. Then the difference here, that is 7,100 minus 10,000, we should come to 2,900, if I'm not mistaken there. This is our balance CD, which means the closing balance BD should be 2,900. Okay, this one we did this, the equipment, the capital, they're just the same there. On inventory, we can as well do the closing. We can do the closing for inventory. If we do the closing, the 5,000 is the large amount, should appear on both sides, 5,000. So the balance, my computer is about to close power issues. So the balance CD there should be 2,500. So the balance BD should be 2,500. Okay, 2,500. For suppliers, this one is cleared itself, 5,000, 5,000, just the same. So actually there's no balance BT for supply account. It has been cleared because they have been paid. The statement is saying they were paid, everything was paid. So we are done. The supply account has been closed. Sales, there were 4,000. Cost of sales was like that. All these rent was like that. So the accounting equation by the end of the day is actually showing the cash 2,900, which we have found out is the balance BD there, the 2,900. Okay, and equipment 2,000 is just the same balance. Inventory, because we sold only half and we are left with 2,500 worth of inventory, so that's good. And then due from customers, the customers, did they pay us? They didn't pay us, so they are still owing us. So these are the dues from the customer, the receivables of 4,000. All these are the assets the business is owning. Okay, so these are our assets, which are equal to the things owed by the business, that is the capital and the profit. Okay, the capital and the profit. Remember, the profit is going to be 4,000 minus 4,000 was the sales. Remember, these are the sales minus the sales minus the cost of sales. These are the cost of sales, the COGS, right? The cost of sales, the cost of the inventory was sold, 2.5. So that we get the profit there, less the rent which was paid, the rent. So this is going to give us the profit there. And if we do the mathematics, 10,000 plus 4,000 minus 2,000 minus 100, we should come to 11,400. So this is the capital element only. We don't have the liability. Why? Because the payables were settled in full. All right. So here the equation is only A is equal to C. Why are we saying C? It is C only that is appearing in the capital. The profit and the profit of the business is actually grouped as part of the owner's money. It's not a liability. It's part of the owner. They belong to the owners. All right. They belong to the owner. So they are just part of the capital. Is that clear? Please get that right, because it is a tricky issue in the examination. So after you do everything, after you have closed up the accounts, you have done the balancing, the balance CD, balance BDs and so forth, you then have to come to the trial balance. At any stage, the sums of debit balances and credit balances should be the same. This is because we were strict to always have equal debit and credit entries. These totals are the trial balance. So we have created a trial balance for everything we have done so far. Remember, for the cash, cash is an asset. We said the closing balance was 2,900. So in the trial balance, it should appear as 2,900. And on the debit side, remember the assets are on the debit and other items will be on the credit as appropriate. So the cash is 2,900, debit. Equipment was also 2,000, which is an asset and it should be on the debit of the trial balance. Then capital, remember we are still following the PO's acronym. The share capital should be credit balance. The inventory balance is, the inventory which was not sold is an asset and is on the debit side of the trial balance. The suppliers have got zero. Why? Because we have settled everything. The liability was settled. So this is why we are having a zero there. All right. The customers are still owing us our 4,000. They haven't paid us anything. All right. Although we have realized the profit. Why? Because we use the matching concept that says, regardless of the fact that we were not paid, it's still our profit. It's still our income. All right, we've made a sale. All right, so we need to recognize revenue. Okay, so the sales, so here, the customers are still owing us. These are the receivables, remember, just still owing us. Then the sales is 4,000. All right, the sales are by nature credit entries. Then the cost of sales being a cost is a debit. All right, rent is an expense, is a debit. So you need to total up and they should add up to the same amounts. If they are not balancing, then something could be wrong somewhere. Okay, so profit belongs to the owner, as I've already indicated. Therefore, profit increases capital. I said this. So the extended equation, which normally comes in your examination, is this one. Closing net assets is equal to opening capital plus capital introduced plus profit minus drawings. Please always note this. Always remember this. So an example, net assets on 1 January were $15,000. Net assets on January 31 were $19,000. So owner took 750. That was the drawings. What was the profit? So using the equation there, you can see that 19 minus 15,000 is equal to 4,000, which there was an increase in wealth. Since 750 was taken out, the business must have actually earned 4,750. You can just slot in these figures to see. For example, the opening capital 15,000 plus capital introduced. Unfortunately, we do not have the rest of the items there, but we can safely, make sense of the formula. Remember, when we are talking of closing net assets, we are simply talking of the difference between the opening and the closing capital. The difference between the opening and closing net assets. So that's closing net assets. All right. So if we were having the net assets of 15,000 at the start of the year and 19,000 at the close, so we can safely say we have got a 4,000 increase in net assets or increase in wealth. All right. So if we are then told that the owner has taken out something, it means that we then have to add that amount which was taken out for us to arrive at the profit of the business. So it's an issue of rearranging the formula. Remember, if we are to calculate profit, we need to make the profit subject of the formula. So let us rearrange the formula to make sure that the profit is on its own side. So to remove or to make profit subject of the formula, we then have to put the other aspects on the other side of the equation. So let's start with the profit. Profit should be okay. Sometimes if I start from saying the profit, let us just leave the profit where it is, but move other variables. So if we move drawings to this side, we just want the profit to remain where it is. So if we want to remove drawings to the other side, it means that we are going to have an equation like this. We're going to have let's say closing net assets, because drawings were having a negative there. They were having a negative. So it means that when they come to the other side, they're going to be added, isn't it? So plus drawings, closing net assets plus drawings. All right. What other items? This one, the opening. Remember, the opening was a positive figure. Why? Because there is a hidden positive sign there. So when we want to push this to the other side of the equation, we're going to say minus opening capital. All right. This one was positive, so we are going to say minus capital introduced. All right, is equal to profit. So this is equal to profit. All right. So this is why I said we can as well write it as profit is equal to closing net assets, okay, plus drawings minus opening capital minus capital introduced. So knowing this is why we are having this statement. All right. Closing net assets. The net assets were 19,000. Remember, these were the closing. The net assets at the year end at the closing. So closing net assets were 19,000. All right. Now, closing net assets. Now, the opening capital has to be deducted. And how much was the opening capital? I mean, the opening net assets. The opening net assets were 15,000. All right. Was there any capital introduced? No, we were not told. All right. Then what about the drawings? We were told that the owner took 750. So we are going to say add 750. So 90,000 minus 15,000 should actually give us 4,000. Okay. And then we have to add 750, which was taken out by the business, because they took the money from the profit. Obviously, that's the assumption, isn't it? So the profit they would have made should be 4,750. I hope I have been understood there. So this is the summary. Prime entry or books of prime entry are for capturing data quickly. The double entry ensures the accounting equation stays in balance. The general ledger is the source for our trial balance. Lastly, profit increases the owner's stake in the business. I hope, ladies and gentlemen, I've done justice to this lecture and you have been assisted. Please do not forget spreading the word. Transcribe Business School is here to stay, is here for you, is here to assist everybody out there to pass their ACCA examinations. Please continue spreading the good word. Until next time, please continue to feel excited. I mean, very, very excited. I am signing out.